Hey everybody, it's Friday, November the 2nd, and today is Financial Friday. And on Fridays, as you're aware, we do our Q&A and tip of the day. And so, like I told you yesterday, the Q&A and tip of the day for today, Friday, November 2nd, is Parent Plus loans. So, there's a lot to get into this topic. 15 minutes goes by very fast, so I'm going to jump right into it and try to jam-pack this 15 minutes with a lot of information for you. So the first thing that I want to do is to try to set up the context of a Parent Plus loan. And so Parent Plus loans need two other pieces of information in order to come into the mix. And those two pieces of information are your FAFSA. So it's your free application for federal student aid, FAFSA, FAFSA. And the FAFSA produces a metric called the EFC. And the EFC is the expected family contribution. So knowing those things are important, and it's an important part of how Parent Plus loans fit into the picture. So let's talk about that. So when you talk about the Parent Plus loans, it's coming down to a formula, and the formula is based on the family's ability to contribute to the student's ability to pay. And the things that go into that are your income, taxed and untaxed, your benefits. So like if you have benefits like Social Security benefits, those are included. Typically, most of the time, your home equity is excluded. But if you have a second home, the value of your second home would be included. And along with that goes some information about your family size and how many children you have in college. That information goes into your FAFSA, and it is the FAFSA that produces the EFC. And an important thing to note about the EFC is that the EFC is not, let me say it again, the EFC is not the amount of money that you have to pay for college. It's a measure of how much aid you are entitled to, right? So that's what the EFC is and what the EFC does. And then based on the EFC, it talks to your entitlement to the three primary forms of federal aid, which are grants, loans, and federal work study. Okay? So once you've turned in your FAFSA and your FAFSA determines your EFC, then the other thing that you need to know is what they call the COA. The COA is the cost of attending. So the cost of attending minus your EFC is what's left and needs to be funded by the family outside of federal aid, right? So the metric for the EFC, the lowest EFC that you can get is 0. The highest EFC you can get is $99,999. Okay, so when you have your cost of attending and you've subtracted out your federal aid, what's left is what the family has to fund. And the family can choose to do that in a bunch of different ways. And one of those ways is what's known as a Parent Plus loan. So the Parent Plus loan is a loan that is issued by the federal government to the parent for the purpose of funding the cost associated with going to college. So the parent is the borrower, not the student. And Parent Plus funding is usually on top of loan aid that is offered directly to the student. So oftentimes you will see that both the student and the parent are taking out loans in order to fund the cost of attending college. So if you take out a federal student loan, and there are two kinds of Parent Plus loans, There's the federally guaranteed Parent Plus loan, and in addition to that, there is also a private option, and we'll talk about that in just a bit. So a couple of things worth noting about repayment when you take out a Parent Plus loan is that your obligation to repay a Parent Plus loan begins 60 days after the funds are dispersed. Once again, 60 days after the funds are dispersed. Now, you do have some options with respect to that. You don't have to start repaying then. If you are borrowing the funds on behalf of an undergrad, you can delay repayment as long as the student is attending school, so you can delay while they're in school. And while you delay, the interest is accumulating. As soon as your obligation to repay begins, the interest on that loan capitalizes. And what capitalization means in this context is that the interest that has been accruing while you have deferred payment while your child is in school will be added to the principal of the loan at the time that you start repayment, and thereafter interest will be added to the new balance. So basically, over time, you will definitely be paying interest on interest. Okay, so let's see. The standard term of repayment for a Parent Plus loan is 10 years. And you can get a longer repayment period. To do that, you're probably going to get a consolidated Parent Plus loan, which basically, if you remember our previous discussions about student loans, every term that you're in school, you take out a new loan. So let's just say you take out a loan for every term that your child is in school, and your child is in school for 8 terms, you would have 8 separate Parent Plus loans. If you wanted to take advantage of other repayment options other than repaying that loan on a 10-year repayment plan, the way to get to that is to consolidate those loans into a single loan, so you'd have a consolidated Parent Plus loan. And then once you got that consolidated Parent Plus loan, you would be eligible for other payment options like extended repayment terms, meaning that you would be allowed to repay the term in a period of longer than 10 years. And you would also be qualified for a particular income-driven repayment plan called ICR. And the ICR payment is eligible for public service loan forgiveness. So it is the one instance that if you take out a Parent Plus loan, and if the ICR payment works for you, and if you are a public service employee, meaning that you work for federal, state, local government, or a 501c3, then you could take advantage of public service loan forgiveness, which is a 10-year repayment plan, where at the end of the repayment plan, you would be forgiven interest and principal, and the forgiveness is tax-free. Okay. So, couple of things. One is that the Parent Plus loan is tested for creditworthiness. So you have to prove that as a parent, you have a certain level of minimum creditworthiness. So basically, you can't be in bankruptcy. You can't have a bunch of 90-day delinquents. You can't be in default or delinquent on your own Title IV repayment. That's basically student loan repayment. Or if you've gotten an overage in terms of some grant and you have to pay that back, you have to be in compliance with the terms of repayment if, as a parent, you want to borrow additional dollars to pay for your kid. But that's pretty much the basis of the test. Are you paying your bills on time? And if you are, generally, if you ask for a Parent Plus loan, you will get it. But if you ask for a Parent Plus loan and you don't receive the Parent Plus loan, then one of the things that happens is that your undergraduate would become eligible for more student loan borrowing. And so there's kind of a tip of the day here, and that is if you are in a financial struggle, rather than just applying for the Parent Plus loan and hoping that you might be turned down, you might want to approach the financial aid office, have a discussion with the financial aid office about your difficulty, and then make the right decision about what it is that you want to do. Because if you apply for the Parent Plus loan and it's granted, then your undergraduate won't be eligible for the additional lending. So that's a conversation that you definitely want to have with the institution. Now, there's one other thing that I think you should think about, and that is if you're borrowing and if you have home equity, then you might want to consider a home equity loan as an alternative to the borrowing of a Parent Plus loan. Typically, if you have good credit, you're going to get a lower payment, and then you get all of the other creditor rights that you would have with a consumer financial instrument. Remember, we talked about this before. If you take out a federal student loan, there's no right to the bankruptcy court, and the statutes of limitations in all states have been overridden. So it might be worth your time to think about getting a home equity loan, or at least doing the comparison of a Parent Plus loan, a home equity loan. So we're getting to the end of this, but I wanted to take a minute to talk about private Parent Plus loans. Those have been part of the landscape since about 2013, when Congress changed the formula for how interest is determined on Parent Plus loans. So it used to be the 91-day T-bill plus or minus an additional 3%. And now it is the 10-year T-bill plus about 4 1/3%. So with that extra interest applied at the Parent Plus level, private companies kind of felt like they had some room to get in the market and to offer a product similar to Parent Plus that the federal government is offering with a federal student loan guarantee. So you can now go into the marketplace, and private companies are offering Parent Plus loans, or the equivalent of parent loans, loans to a parent for the purpose of financing their child's education. Now, just like the loans that a student can take out, when it comes to Parent Plus loans, there are some differences. One of the differences is the time that you can be in forbearance. If you have a federally guaranteed loan, it's up to 3 years. On a private loan, it is up to 1 year, and not every loan will offer that option. So that's definitely one of the things that you'd want to look at if you were thinking about taking out a private parent loan. Also, in terms of the scrutiny that your financial background is given for the government, it's a de minimis inquiry, basically making sure that you're not delinquent on things. For private student loans is definitely a full-out blown credit review, and you have to have good or excellent credit in order to qualify for a private student loan. Let's see. Interestingly enough, the one opportunity that you have to have a cosigner is if on a Parent Plus loan you cannot meet the minimal scrutiny, they will allow you to have a co-borrower to bring you to the appropriate level of scrutiny. And in the private sector, for private student loans, that would not be required. So that's kind of one place where the requirements flip-flop. And then at the end of it, when you think about refinancing, as we've discussed in the past, there is no capacity for refinancing of federal loans, although you can consolidate them, and consolidation will give you the weighted average of all of the loans, which may reduce the amount of interest that you have to pay, but not likely. And in the private arena, you would definitely keep your eye on interest rates. And if interest rates went down, like any other consumer instrument, you would want to refinance when that became available. So that's our Q&A topic for today, to talk about Parent Plus loans. Our tip of the day is, if you are considering a Parent Plus loan, you might want to look at a home equity loan. And so that's our topic for the week of November 2nd. We thank you for joining us. We're going to ask you to follow us on Facebook or on the gram. We're there as well. You can follow us on Twitter. And we look forward to your support. So please do give us a like on Facebook. And we'll be back next week with the topic of the week. And on Thursday, I'll tell you what it is. And we look forward to seeing you again next week. So thank you for joining. And I'm C. Cole Dillon, and I'm out.